Forget
mathematically
everything you think you know
formula.
about the Gilded Age. Forget the grand mansions, the steamships, and the myths of self-made men. What if I told you the single greatest financial innovation of that era, the very engine of its staggering wealth, wasn't steel, oil, or railroads? It was a lie. A beautiful, seductive, and mathematically fraudulent lie built on paper promises and human psychology. Welcome to the Blood Money Files. Today, we expose how the foundation of modern global finance was poured not with gold, but with quicksand. The post-Civil War world classed the gold standard like a religious talisman, a universal promise of permanent monetary stability. Politicians, bankers, and newspaper editors sold the public a powerful vision. Every dollar, pound, and franc was ultimately redeemable for a fixed, immutable weight of gold. Money was thus rooted in real value, immune to the whims of governments or the madness of crowds. This was the first and most foundational pillar of the Gilded Lie, a narrative of safety that concealed a brutal mathematical tyranny. The fatal flaw was ignored in the celebratory parades for returning to hard money. The global stock of monetary gold increased at a mere 1 to 2% per year, a pace dictated by the painful, dangerous labor of mining. Meanwhile, the industrialized world was exploding. American industrial production, driven by steam, steel, and immigrant labor, grew at over 5% annually. Railroads laid tens of thousands of miles of track each decade, exponentially increasing trade volume. The supply of goods and services was ballooning, but the supply of the money needed to buy them was on a short, tight leash. This mismatch created a silent, crushing economic force, chronic deflation. As the money supply failed to keep pace with real economic growth, the value of each individual dollar, pound, or franc increased. This meant general prices fell year after year. On the surface, this might sound like a consumer's paradise, cheaper goods, but the reality was a systemic engine for impoverishment and transfer. For the wheat farmer in Kansas, the cotton planter in Georgia, or the factory worker in Pittsburgh, falling prices for their crops or labor meant their nominal income dropped. They were getting paid less for the same, or more, effort. However, their debts, the mortgage on their farm, the loan on their equipment, were fixed in dollar terms. As the value of the dollar rose, the real burden of that debt grew heavier. They had to produce more and more bushels of wheat or work more hours just to pay back the same number of, now more valuable, dollars. The beneficiaries of this mathematical vice were the creditors, the banks holding the mortgages, the bondholders in Boston and London, the new class of financial rentiers. Their static assets gained purchasing power without them lifting a finger. The system was not neutral. It was an engineered constraint that systematically transferred wealth from the producing, borrowing majority, the farmers, entrepreneurs, and industrial laborers, to the lending, asset-holding minority. It penalized dynamism and rewarded stasis. This relentless deflationary pressure created a desperate, widespread hunger for credit, a hunger that could not be satisfied by the meager annual trickle of new gold. That hunger, that gap between the booming real economy and the constrained money supply, set the stage for the era's true alchemical engine. The fabricated paper money that would build the visible wealth of the age on an invisible foundation of pure confidence and complex ledger entries. The gold standard wasn't the anchor of prosperity. It was the straitjacket of scarcity that made the subsequent financial magic and fraud both necessary and incredibly profitable. If the gold standard was the straitjacket of scarcity, then fractional reserve banking was the magical escape act that built the skyscraper of Gilded Age wealth on a postage stamp of gold. This was not a minor technicality of finance. It was the central, alchemical engine of the era. The principle was simple yet world-bending. Bankers realized they did not need to keep 100% of their depositors' gold coin in the vault. By law and custom, they only needed to hold a fraction, often 10%, as a reserve. The remaining 90% was not sitting idly. It became the seed for new money. When Mrs. Jones deposited $100 in gold, the bank would record $100 as a liability to her. But on the asset side, it could now create a $90 loan to Mr. Smith simply by crediting his account. No physical gold moved to Smith. The bank created a $90 claim on itself, a promise to pay gold that it did not physically possess. Smith now spent that $90, which was deposited in another bank, which then lent out $81 of it. and so on. Through this multiplier effect, the original $100 in hard gold could, and did, spawn over $900 in checking account money throughout the banking system. This process, credit creation, meant private banks were not mere intermediaries between savers and borrowers. They were the genesis point of new purchasing power, architects of the money supply. Every loan they issued conjured money into existence with an accountant's pen. The entire booming economy of railroads, factories, and cities became leveraged on this fragile, beautiful premise. The system's stability was a grand psychological trick, a shared fiction. It relied entirely on the unwavering belief that not all depositors would simultaneously demand conversion of their paper claims into physical gold. It was an inverted pyramid, with a narrow, tangible base of metal supporting a vast, trembling superstructure of paper promises and ledger entries. Bank panics, therefore, were not unfortunate accidents. They were the inevitable mathematical correction when confidence wavered and the collective fiction was tested. When depositors, fearing a bank's insolvency, rushed to get their money out, they were demanding the conversion of the pyramid's top back into its tiny base, an impossible request if made by enough people at once. This inherent instability was the dirty secret of the miracle. It concentrated unimaginable power and risk in the hands of private bankers, who now controlled the spigot of the nation's lifeblood. They decided which industries, which regions, which men got the newly created money, directing the course of national development while profiting from every drop. The alchemy was real, but its product was not gold. It was debt, risk, and a vulnerability masked as prosperity. The chaotic, panic-prone system of thousands of independent banks, each performing this alchemy, was too unstable, even for the robber barons who benefited from it. The solution was not more regulation, but the consolidation of this money-creating power into a private cartel. This led to the rise of the money trust, an informal but devastatingly potent network that gave a handful of New York bankers de facto control over the capital flows of an entire continent. J.P. Morgan was its undisputed architect and emperor. Through interlocking directorates, Morgan and his peers placed their partners on the boards of major corporations, banks, and insurance companies. Through pooled resources, they could underwrite massive securities issues, deciding which railroads or industrial combines would have access to capital markets. Through control of the primary clearinghouses and correspondent banking relationships, they could extend or call in credit lines to smaller banks across the country, acting as a shadow central bank. The Panic of 1907 was their masterpiece and their ultimate proof of concept. The panic began with a failed attempt to corner the stock of a copper company, which collapsed a major brokerage and triggered a run on the trusts and banks associated with it. As the crisis threatened to cascade into a total meltdown of the New York Stock Exchange and the banking system, there was no Federal Reserve to intervene. Instead, the U.S. Treasury Secretary literally handed the nation's financial stability to a private citizen. J.P. Morgan, then 70 years old, summoned the city's leading bankers to his opulent library. He locked the doors and, over the course of a tense night, forced them to pool millions to shore up failing institutions and provide liquidity to the stock exchange. He decided who would fail and who would be saved, based on his assessment of their systemic importance and his own firm's exposure. This was not a government bailout. It was a private, plutocratic takeover of monetary policy. The events revealed the truth. The American financial system was not a free market of competing equals. It was a private oligarchy, a money trust, where stability was a favor granted by a financial sovereign. The public and political outrage this generated was paradoxically the trust's greatest triumph. The subsequent movement to create a central bank, the Federal Reserve System established in 1913, was heavily shaped by Morgan's disciples. In many ways, the Fed became the government-sanctioned, public-facing version of the money trust, moving the ultimate power from Morgan's private library to a marble building in Washington, but leaving the fundamental architecture, centralized control of credit, firmly in the hands of financial elites. The physical symbol of Gilded Age progress, the Transcontinental Railroad, was financed by history's first massive, systemically risky derivatives bubble, railroad bonds. These were not simple loans. They were complex debt instruments, promises of future income based on projected traffic over rails not yet laid across deserts and mountains. Sold to eager investors in Boston, New York, and London, they were marketed as safe, fixed-income investments in the nation's manifest destiny. The mathematics behind them, however, were speculative fantasy. Construction costs, plagued by graft, inefficient logistics, and geographic challenges, were routinely 200 to 300% over initial estimates. The value of federal land grants, given as subsidy, was wildly inflated on balance sheets. Projected traffic numbers were pure fiction, assuming settlers would magically fill empty plains at impossible rates. Promoters like Jay Gould, Collis Huntington, and Leland Stanford engaged in a shell game of epic proportions. They formed construction companies, which they owned, to build the railroads. The railroad, funded by bondholders, would pay exorbitant fees to the construction company, owned by the promoters, siphoning capital directly into their pockets. They issued bonds for competing lines over identical routes, creating absurd overcapacity guaranteed to bankrupt all but one. They made fortunes on construction contracts, bond flotation commissions, and insider land speculation, completely decoupled from the railroad's eventual operational viability. When the railroads inevitably failed to generate the revenue needed to pay bond interest, they defaulted. Committees of bondholders, often represented by the same Wall Street banks that sold the bonds, would then reorganize the company, wiping out the original investors and issuing new securities at a discount, which the insiders would snap up. This cycle of fraudulent speculation, collapse, and reorganization transferred vast wealth from dispersed, passive investors, teachers, clerks, widows with savings, to a small cabal of insiders. The transcontinental network was physically built, a monumental engineering achievement. But its financial architecture was a ruinous, predatory machine. It established the enduring blueprint: package risky, speculative ventures into complex debt securities, sell them as safe investments to a credulous public, collect fees up front, and let the public bear the ultimate risk. The railroad bond bubble was the direct progenitor of the mortgage-backed security, the collateralized debt obligation, and every subsequent iteration of Wall Street's genius for privatizing gains and socializing losses. The myth of laissez-faire, of a government that stood aside and let natural, economic forces work, is the Gilded Age's most persistent and pernicious lie. The titans of industry were not rugged, free-market individualists battling on a level playing field. They were masters of state capture, adept at using political power to rig the economic game in their favor. The protective tariff was their primary legislative weapon. Duties on imported steel, manufactured goods, chemicals, and textiles were pitched to the public as protecting American jobs and infant industries. In reality, once an industry was no longer an infant, like Carnegie's steel empire by the 1880s, the tariff became a government-enforced price-fixing mechanism. It eliminated foreign competition, allowing domestic monopolists and trusts to charge higher prices to American consumers and businesses. Andrew Carnegie's immense profits were built behind a wall of tariffs that sometimes exceeded 50%. Who bore the cost? Every farmer in the Midwest who had to buy overpriced steel plows and manufactured goods. Every working-class family paying more for basic commodities. The tariff was a regressive tax that transferred wealth from the entire consuming public directly to the coffers of protected industrialists. Simultaneously, the land grant subsidy to railroads constituted the largest corporate welfare scheme in 19th century America. The federal government gave railroad companies over 170 million acres of public land, an area larger than the state of Texas, along with millions of dollars in low-interest loans. This wasn't a loan to be repaid with interest, it was a gift. The railroads sold this land to settlers and speculators to fund construction, making them the continent's greatest real estate moguls. This transfer of public wealth to private corporations was justified as building national infrastructure, a necessary cost for unification and progress. But it created instant, landed aristocrats who controlled not just transportation, but the very pattern of Western settlement and the value of the land itself. The state was not separate from the market. It was the essential, active partner that created the conditions for monopoly. It used law to stifle competition, tariffs, and public resources to fund private capital accumulation, land grants. The game was rigged from the start. The legendary competition of the era was not a free-for-all. It was a brutal tournament held inside a stadium built, funded, and regulated by the state for the benefit of the largest players. To understand Gilded Age wealth is to discard the fairy tale of the self-made man operating in a vacuum. His genius lay not in escaping government, but in harnessing it as the most powerful tool in his financial arsenal. In the double-entry ledgers of the Gilded Age Corporation, human labor was accounted for not as capital to be cultivated, but as a variable cost to be minimized, like the cost of coal or iron ore. The wage system was mathematically engineered to extract maximum physical productivity while conceding the smallest possible share of the generated economic surplus to the worker. With no federal income tax until 1913, the concentration of this surplus was absolute. Historians estimate the top 1% of American households saw their share of the nation's wealth soar from about 25% in 1860 to over 45% by 1900. Meanwhile, the story for the average industrial worker was one of stagnation and precarity. While nominal wages, the dollar amount paid, did rise slightly in some periods, real wages, adjusted for the cost of living in crowded, company-controlled tenements and the constant risk of crippling injury or death, showed little sustained improvement for decades. The mathematical model pursued by capitalists like Henry Clay Frick, Carnegie's operations manager, was starkly clear. Keep labor costs as flat as possible while output per worker skyrocketed through mechanization, the moving assembly line, and scientific management, Taylorism. The difference, the massive and growing productivity gap, flowed entirely to capital, to be paid out as dividends to stockholders or reinvested in labor-saving machinery. Workers became cogs in a machine designed to make their role ever more replaceable. The violent labor struggles that defined the era, the Great Railroad Strike of 1877, the Homestead Strike of 1892, the Pullman Strike of 1894, were not mere disputes over fairness. They were desperate, collective attempts by labor to alter this fundamental equation, to claim a greater variable in the profit formula. They were met not with negotiation, but with private armies, the Pinkerton Detective Agency, state militias, and federal troops deployed to break strikes and protect property. The state's role was to use force to preserve the existing mathematical imbalance, ensuring that the human cost remained a low, fixed entry on the liability side of the industrial ledger. The gospel of wealth preached philanthropy, but the operating system enforced a brutal calculus where human beings were inputs to be optimized, their value depreciating with every technological advance. To justify the staggering, mathematically engineered inequality, the elite required a moral and intellectual framework that transformed exploitation into virtue. They found it in a corrupted, popularized version of social Darwinism. Philosopher Herbert Spencer and his American apostle William Graham Sumner took Charles Darwin's biological theories of natural selection and survival of the fittest and crudely applied them to human society and economics. They argued that cutthroat business competition, the accumulation of vast fortunes by a few, and the concomitant poverty of the masses were not social problems, but simply the working out of immutable natural law. The fittest, deemed so by their financial success, were naturally rising to the top, while the unfit, poor deserved their fate due to laziness, incompetence, or inferior biology. Poverty was not evidence of a flawed system. It was proof of individual moral and biological failure. This philosophy provided a powerful, scientific justification for opposing all forms of government intervention, regulation of monopolies, safety laws, labor rights, social welfare, and even public education. To interfere was to tamper with nature's wise, if harsh, process of improvement. It turned the ruthless pursuit of monopoly from a crime against the public interest into a noble, evolutionary duty. Andrew Carnegie's Gospel of Wealth was the softer, more paternalistic side of this same coin. He argued that the wealthy were society's natural stewards, uniquely qualified by their success to distribute surplus wealth via libraries, concert halls, and universities, better than the government or the masses themselves could. This ideology served as the essential psychological keystone of the Gilded Lie. It performed a critical alchemy. It transmuted structural exploitation, enabled by financial and political rigging, into an inevitable and morally justified law of nature. It disarmed critique based on justice, empathy, or equality by labeling such sentiments as sentimental obstacles to progress. By framing the economy as a jungle governed by natural law, it obscured the man-made, manipulable rules of the financial and political jungle that the elite themselves had written. The inherent instability of the credit pyramid and the speculative excess it fueled manifested not in smooth growth, but in a brutal, predictable rhythm, the financial panic. These were not random acts of God, but systemic seizures, the house of cards shuddering as its flawed mathematics were exposed. The Panic of 1873 was triggered by the collapse of the premier investment bank, J. Cook and Company, overexposed to the insolvent Northern Pacific Railroad and the collapsing railroad bond bubble. It sparked a 6-year depression, the Long Depression, with waves of bank failures and unemployment exceeding 14%. The Panic of 1893 was even deeper and more prolonged. Its immediate trigger was the failure of the National Cordage Company, but its root cause was a run on the U.S. Treasury's gold reserves. The Sherman Silver Purchase Act had required the government to buy silver with gold-backed notes, leading investors to fear a departure from the gold standard. They rushed to exchange paper currency for gold, draining Treasury reserves below the critical point. Nearly 500 banks and 15,000 businesses failed. Unemployment may have hit 25%. The Panic of 1907, as detailed, was the money trust moment, contained only by J.P. Morgan's private intervention. The mathematical trigger in each case was the same, a spark of doubt that caused a critical loss of confidence in paper claims. This led to a run on banks or the Treasury, as holders sought to convert those claims into the ultimate base money, gold. Since the entire system was built on the assumption that not all would do so at once, any significant run caused immediate, cascading failure. Banks called in loans to raise cash, forcing businesses to sell assets at fire sale prices, crashing markets, and causing more failures, a vicious, self-fulfilling spiral. These panics served a paradoxical, cleansing function for the elite. They were moments of creative destruction in the most cynical sense. They wiped out smaller, weaker competitors, both banks and industrial firms. They created mass unemployment, which broke the bargaining power of labor and drove wages down. And they allowed the largest trusts and banks, with deeper reserves, better political connections, and access to the money trust's rescue funds, to acquire valuable assets for pennies on the dollar. Each crash, while painful for the architects in the short term, ultimately reinforced the centralization of capital and power. The panics were not bugs in the Gilded Age system. They were brutal, cyclical features, necessary corrections that validated the power of those who could survive them and profit from the wreckage. Official economic statistics of the Gilded Age, where they existed, painted a dangerously misleading picture of aggregate, top-line growth. Gross national product, GNP, a measure of the total value of goods and services produced, was rising impressively. Railroad mileage quintupled. Steel production overtook Britain's. To a casual observer of the data, it was an era of unparalleled, shared prosperity. But this was a classic, potent case of the fallacy of composition, the error of assuming what is true for the aggregate is true for its individual parts. The average wealth was skewed astronomically by the gargantuan gains of the top 0.1%. For the vast majority, the reality was captured not in GNP figures, but in other, more human datasets. Life expectancy in industrial cities like New York and Chicago was often a decade lower than in rural areas, due to disease, pollution, and accident. Infant mortality rates were horrifyingly high. Workplace injury and death rates in steel mills, mines, and railroads were catastrophic, with few systems of compensation. Economists like Simon Kuznets, analyzing data later, demonstrated that this period saw some of the highest levels of income and wealth inequality ever recorded in the Western world. The wealthiest era was, for most, a statistical illusion created by extreme concentration at the pinnacle. The booming stock market and bond prices breathlessly reported in financial pages reflected the fortunes of the investing class, perhaps the top 5% of households, not the lived reality of the producing class. A factory worker did not own railroad bonds. A seamstress did not benefit from Carnegie Steel's rising dividend. For them, Economic security was a day's wage away from destitution. This stark disconnect between aggregate financial data and mass human welfare is the essential, telltale hallmark of a house of cards economy. The facade, the glittering skyscrapers, the yachts, the reported GDP, grows ever taller and more impressive. But the foundation, the health, security, and purchasing power of the broad population, remains weak, strained, and perpetually at risk of collapse. The Gilded Age perfected the art of building magnificent economic indicators on top of a suffering populace, a trick that required both financial engineering and ideological control to maintain. The Gilded Age was not a purely American phenomenon. It was the explosive growth of the Anglo-American core within a newly forged and brutally hierarchical global financial order. The deflationary pressure of the international gold standard and the insatiable need for perpetual growth to justify speculative investments forced the great powers into a ruthless game of economic imperialism. Britain, France, and, increasingly, the United States used financial power as a tool of geopolitical control. They did not always need to plant a flag. They could plant a bond. Investment banks like Baring Brothers and J.P. Morgan and Company would issue loans to governments in Latin America, the Ottoman Empire, Egypt, and China for railroads, ports, and other infrastructure. These bonds were sold to Western investors, hungry for higher yields. When these countries, often with economies vulnerable to commodity price swings, could not service their dollar or pound-denominated debts, the crisis became an opportunity. The lending powers would demand control over the debtor nation's customs revenues or national treasury as collateral. In extreme cases, as in Egypt in 1882, financial control precipitated a military invasion and full colonial occupation. This was not mere investment. It was debt peonage at a national scale. The wealth extracted via debt service and the control over trade routes and raw materials provided essential capital inflows and price stability for the financial centers of London and New York. The gold standard acted as the monetary transmission belt of this empire. Peripheral countries were forced to adopt it to access capital, which then tied their economies to the deflationary discipline of the Bank of England, often crushing their domestic development. The stability and prosperity of the core's financial house of cards became structurally dependent on the systematic economic destabilization and exploitation of the periphery. The Gilded Age glitter was, in part, polished with gold extracted, both literally and figuratively, from across the globe, in a system where financial diplomacy often masked a new form of conquest. The Gilded Lie, for all its power, did not go unchallenged. A powerful intellectual and journalistic counter-movement arose, dedicated to dissecting its mathematics and denouncing its morality. These were the demystifiers, the ones who pulled back the curtain. Muckraking journalists, armed with new mass circulation magazines like McClure's, exposed the predatory mechanics behind the myths. Ida Tarbell's meticulously researched 19-part series on Standard Oil detailed Rockefeller's use of secret rebates, espionage, and predatory pricing to crush competitors. Lincoln Steffens exposed the systemic political corruption in cities like St. Louis and Minneapolis, showing how business bought legislation. In academia, a new economics emerged. Thorstein Veblen, in his theory of the leisure class, coined the term conspicuous consumption and analyzed the economy not as a rational market, but as a system of predatory power and status-seeking where industrial sabotage, plant scarcity, was used to maintain profits. In the political arena, William Jennings Bryan, with his Cross of Gold speech, gave thunderous voice to the agrarian debtors being crushed by the deflationary gold standard. Socialists like Eugene V. Debs, radicalized by the Pullman strike, argued the entire wage labor system was inherently exploitative. These critics performed an essential service. They replaced the elite's language of natural law, social Darwinism, and divine right with a language of power, privilege, manipulation, and stolen surplus. They showed that the financial system was not a complex, incomprehensible force of nature, but a human-built machine with levers and gears that could be understood, critiqued, and potentially redesigned. This intellectual revolt created the capital, the ideas, the outrage, the factual ammunition that would fuel the progressive era reforms of the early 20th century. They proved the system was not immutable, but a contingent, contested construct. The first step to changing the rules of the game is to show that the game is rigged, and these were the era's master exposés. The ultimate testament to the political power of the money trust was not its defeat, but its institutionalization. The creation of the Federal Reserve System in 1913 sold to a panic-weary public as the great reform that would democratize money and end banking crises was in fact a masterpiece of regulatory capture. Its design was heavily shaped by the very bankers. Most notably, Morgan ally Paul Warburg, it was meant to oversee. The compromise structure of a decentralized system of 12 regional banks was a concession to populist fear of a Wall Street monopoly. In practice, power immediately concentrated in the Federal Reserve Bank of New York, whose first governor, Benjamin Strong, was a former Morgan banker. The New York Fed became the nexus where Wall Street's interests were translated into policy. Crucially, the Fed did not end the private creation of money through fractional reserve banking. Instead, it became its ultimate backstop and guarantor. It provided a lender of last resort, a source of emergency liquidity, newly created Federal Reserve notes that banks could borrow against their assets during a panic. This socialized the risk that had previously been borne by private banking consortiums like Morgan's. No longer would A.J.P. Morgan need to lock bankers in his library. The government itself, through the Fed, would now ensure the survival of the system. In essence, the public taxing power and authority were now pledged to protect the private credit pyramid from its own inherent instabilities. The Fed institutionalized and legitimized the core mechanisms of the Gilded Age, private credit creation, centralized control of interest rates and money supply, while draping them in the cloak of public purpose, scientific management, and stability. It moved the house of cards into a grand, government-sanctioned building with a marble facade, where the levers were still pulled, albeit more subtly, by financial technocrats deeply enmeshed with the world they regulated. The Panic of 1907 was the last panic of the old, purely private system. The Fed was the new system's answer, not to dismantle the power of the money trust, but to make it official, permanent, and far more resilient. The house of cards is more sophisticated now, globalized, digitized, wrapped in impenetrable layers of legal complexity and financial jargon. Its tremors are felt worldwide in seconds, but its fragility is still mathematical. It still ultimately rests on confidence in intangible claims, the full faith and credit of institutions, the valuation of digital assets, the promise of central banks. It still depends on the unequal distribution of the power to create and allocate credit. Understanding the gilded lie is therefore not a dusty academic exercise. It is the first, essential step in financial and historical literacy. It is the realization that our economic world is not built on immutable laws of physics, like gravity, but on contingent, man-made, and often exploitative rules written by specific people at specific times for specific ends. And the most powerful lesson of all, rules written by men can be rewritten by them. The question for our era is not whether our system is a new version of the old house of cards. It is. The question is whether we, like the muckrakers and reformers of the past, have the will to see its blueprint clearly and the courage to demand a new architecture. So, the gleaming edifice of the Gilded Age, the era that forged our modern world of finance, was not built on a foundation of gold, innovation, or virtuous competition. It was a meticulously engineered mathematical illusion. A house of cards constructed from the alchemy of fractional reserve banking, the political rigging of tariffs and subsidies, the ruthless suppression of labor's share, and the philosophical smokescreen of social Darwinism. Its legacy is not just in our history books, but in the very DNA of our financial systems, our cycles of boom and bust, and our staggering inequalities. The formulas devised in the late 1800s are still running in the background today. If this deep dive into the hidden architecture of power has changed your perspective on where money really comes from, then your next essential chapter is waiting. Our upcoming investigation, The Debt Dynasty, How One Family Secretly Owned the 20th Century, picks up where this story ends. We trace how the financial blueprints of the Gilded Age were refined into an even more powerful and invisible system of global control. It's a story of private central banking, world wars, and the birth of the perpetual debt economy. To make sure you don't miss it, subscribe to Blood Money Files and hit the notification bell. The True History of Money is a series, and we've just exposed the first foundational lie.